2020, but you gotta attach that special election on your tax return. It's not automatic. That election has to be part of your tax return. One of the things I like about a couple of things under the old tax law. The old tax law, because it gave you an opportunity to carry it back 2 years, and it allowed you to offset up to 100% of those 2 years taxable income, or whatever your net operating loss is. It's allowing you to get a refund for taxes that you paid in the previous 2 years. That's a good thing. That's money in the taxpayer's pocket. I actually like that specific provision. But if you're more of a tax planning in the future, if your business is new, then going forward may actually make more sense. If you foresee your revenues increasing significantly, then maybe electing to carry back, foregoing the carry back and carry it forward may actually work. That is an old trick that people used to do on a case by case basis. Um, Now, for 2018 to 2025, and this sounds a bit confusing because the way it's set up. NOLs are only carried forward indefinitely, so there's no 20-year limit. It's carry forward until it's exhausted. There is no carry back, only carry forward. NOLs are limited to 80% of future taxable income. So you can't use 100% of the taxable income. It's 80%. So they're in essence paying taxes on 20% of their taxable income. So even though it does create advantages for the taxpayer, it's still providing some source of revenue for the government. So keep in mind, the Tax Cuts and Jobs Act did favor heavily businesses, but at the same time, they wanted to create a balance to generate some type of revenue. Again, tax bills are always revenue bills as well. They're budget bills. They have to balance and find ways to generate revenue. So this was the way to generate the revenue, temporarily at least. So here comes the CARES Act, the CARES Act that just passed a couple months ago, and there may be a new provision, a new Corona Relief Act. We don't know what's going to be in it, so I don't want to talk about it. I'll talk about what has passed, the CARES Act that passed way back in March. They did provide quite a bit of relief for businesses. So NOLs that were incurred in 2018, 2019, and 2020 has a bit of the old rules, meaning the NOLs can be carried back, but instead of 2 years, they allow the taxpayer to carry back for up to 5 years. That 80% limitation that was part of the new tax law, that's gone. Again, for only NOLs that occurred in 2018, 2019, and 2020, they are able to use 100% of taxable income to whatever year they're carrying it back to. They're able to, or whatever the NOL is. So that's actually pretty good. So that's giving an opportunity for taxpayers to amend the 2018 return, or apply the NOL rules in 2019 or even in 2020. I'm not sure if this would get extended for 2021. That's kind of hard to say. But right now, at 2018, 2019, and 2020 has a bit of the old rules. So I'm guessing if nothing changes in 2021, it's going to go back to the Tax Cuts and Jobs Act, rules. Carry forward only and limited to 80% of future taxable income. That's what I foresee happening if Congress doesn't extend it, and I'm not sure it will get extended. It's kind of hard to say. Now, in terms of the carryback provisions, if you're trying to carry it back, well, there's a couple ways of doing it. Of course, you can always get a refund through amending your tax returns. But let's say you're carrying it back 5 years. So that means you're going to do amended returns for the last 5 years. Well, yeah, you could do that. The other option is to file what's called an application for a quick refund due to the NOL. That's Form 1045 for individuals. In essence, you're doing an amended return because you're recomputing the AGI, you're recomputing taxable income, and so forth. But you also got to keep track of the NOL. But that's actually just one form. So keep in mind, instead of filing 5 amended tax returns and the 1045, it's all part of one form. They're going to process it as one, tax return, and the refund is actually going to be, quicker. They may ask additional questions depending on the circumstances. They may not. Again, it all depends on the facts and circumstances. Corporations, same rules apply, except they use Form 1139 for instead of 1045. Quick question. So, what about partnerships and S corporations? What forms do they use for their NOLs? I'll give you a hint. This is sort of a trick question. Anybody want to take a stab at that question? Again, what do partnerships and NOLs use for their, I mean, what do partnerships and S corporations use for their NOLs? I'll give you a hint. Think of the core concept of behind S corporations and partnerships. Do they pay taxes? No, right? Who pays taxes on the income from the partnership or the income from the corporation, the S corporation, the owners? So exactly. So if the owners are individuals, what form are they going to use? 1040.
1040.
Yeah, 1045. If the owners of the LLC or the partnership are corporate owners, what form are they going to use? 1139. So that's how it works. So it's going to flow to the individual, whoever the owners are. But then just because there's a net loss from the business doesn't mean that that's going to create a net operating loss in the corporation or the individual. It may lead to it, or it may be part of it, but that by itself will not create a net operating. All right, who's that? I'm sorry. Can you please put your on mute, please? I don't know who that is. I'm hearing background noise. I hear a turning signal. Is that a turning signal?
It sounded like it.
All right, you guys got to be honest with me. Who is driving right now and while this class is going on? Come on, be honest with me. Let me see.
It's
Anybody?
hello.
Yeah, is that you, Gabby?
Yes, I'm sorry. I just had a job interview and I couldn't make it back home on time.
Oh, did you get the job?
Yes,
All right, congratulations. Then that's fine.
thank you.
Well, if you got the job, that's acceptable. All right, but please put your microphone on mute so it doesn't disrupt the class. So we're happy for you. Congratulations on your new job. Just this is going to be recorded, but that's as long as you can follow it. Just refer to it later and get notes from a fellow classmate. All right, so back to the steps that's involved for NOLs. I want you to commit these steps into memory. This is another computational steps that I want you to know. These are the steps. Again, please put your phone on or microphone on. I'm not sure who that is. Dan, is that you?
No, I was on mute.
Matt, I don't know. Matt is.
That may have been my phone picking up because I was having trouble with the computer audio. I dialed in through my phone.
Oh, okay. Yeah, I'm okay now. I don't hear the background noise anymore. I hear the steps for NOLs for individuals. For corporations, believe it or not, is actually simpler than these steps. Again, just understand the process. When if you understand how to do tax returns, you're doing the Schedule C first. So compute net loss from business. So this is Schedule C, right? Schedule C. So you're doing the Schedule C first, right? First before 1040, if you think about it. And then you compute adjusted gross income. And then it's 1040, right? Again, what's the part of adjusted gross income? You gotta include whatever's part of gross income, subtract your AGI deductions, any other AGI deductions, and then you figure out your adjusted gross income. And then you figure out taxable income. That's Form 1040. Again, this must be negative, but this is not the NOL. And then we figure out the net operating loss. See below. So pretty straightforward. You do the business revenue minus business expenses. That's your Schedule C. And then you figure out what else goes on your 1040. So if you think about it, step 2 and step 3, figuring out the adjusted gross income and taxable income, you can actually put this into one step because that's all part of your tax computation. Gross income, adjusted gross income, then taxable income. So when I'm actually going over this, I may actually just go straight to the taxable income, but I am going to give you a subtotal for adjusted gross income. But the reason why I have it in multiple steps, because as we know, you got to do your adjusted gross income first before you do your taxable income. I want you to remind you of that. But in terms of how do we do the NOL, well, it's actually a bit different depending on which years you do it for. Now, this taxable NOL computation for NOLs for 2018 to 2025, even with the CARES Act, and you're going to see why. Again, even with the CARES Act, this is the computation. You're going to start out with your taxable income, whatever you came up with in your previous step, that has to be negative, and you're going to add back the excess of your non-business deductions over your non-business income. So again, non-business deductions over non-business income. So let's actually talk a little bit about that. So let's do a quick review. Types of income. So in a previous session, I gave you 3 different types of income. I know one of them is active. What is active? That's like earned income, right? I said something about material I can't even spell today. Material participation has to be present. So what did we talk about? Salaries, right? Wages, SE income, right? And what is the other activity? We had portfolio, right? Portfolio, and that's like investment income. What was the third category? Anybody?
Passive.
Passive. No material participation. So what I want you to remember when we're dealing with business income, if you're thinking about business income, this is, when they're referring to business income, it refers to active income. So that includes salaries and wages. So that keeps in mind, and whatever is not part of, category 1, it's non-business income. So we have portfolio income, investment income, that's non-business income. If we have passive income where there's no material participation, that's non-business income. So again, if it's not part of category 1, if it falls in category 2 and category 3, that's non-business income. So we actually have to factor that in as part of our computation. So what are, non-business deductions? Non-business deductions are, so what are non-business deductions? How can we answer that? Answer. Non-business deductions are non-business deduction. I know I'm being redundant, right? It's actually for a purpose if you think about it. Let's actually, think about that. Non-business deductions. So what are business deductions if you think about it? So what are business deductions? So I guess think of it this way. It's sort of the similar, process as we figure out what's non-business income. So if it's not active income, it's non-business income. Similar to non-business deduction. So what are business deductions? Well, keep in mind that the business deductions that's already part of Schedule C, that's already computed and part of steps, 1. So keep that in mind. So now we got to figure out, are there any other non-business deductions, or I should say, is there any non-business or any other deductions that's part of the tax return that's not part of business? So just think of it this way. So let's think about non-business losses and deductions. And this actually, I'll give you our list. So again, partial list, by the way. Is there one non-business deduction that exists that just been doubled as part of the Tax Cuts and Jobs Act that exists for individuals? What's the deduction I'm talking about? That's non-business related. It starts with an S.
Standard deduction.
Standard deduction. So standard deduction is a non-business deduction. So in essence, you're adding that back, just like your or minus your non-business income. in addition to non-business deduction, itemized deduction, right? Think about it. Itemized deduction now it's all non-business. Previously, the only business deduction that was on an itemized deduction, what was that before? On the previous tax law, the only item that was deductible that had business attributes that was allowed for business expenses as an itemized deduction is gone. What is that deduction I'm referring to? Employee business deduction. That was the only business deduction that was on the tax return before. Now it's not there anymore. So all your itemized deductions are non-business. How about capital losses, right? What else? Alimony. What else? You guys get the gist of it, right? I'm sort of identifying deductions or items that are not related to business. Is there anything else that I can think of that's a non-business deduction? Let's say tuition and fee deduction, right? Educator expense deduction. Again, think of your AGI deduction. So again, think of AGI deductions that are not business related. And the list goes on and on. So there's actually quite a bit of them. They're not business related. Again, we'll walk through an example in a little bit, but again, I want you to just start thinking of the steps. First, identifying what's non-business income, which is whatever's not in category 1. So category 2 and category 3 would be non-business income. What about non-business deductions? Similar process. What's a non-business deduction? Standard deduction, itemized deduction, capital losses, alimony, tuition. Think of your deduction, IRA contribution. Think of your deductions that are not business related. So again, there's quite a few of them. Now, again, we're going to walk through a step. I'm going to do the NOL computation for 2018 because the only thing that changes is just this step. It's still the same process, but personal dependency exemptions used to be added back. Because if you think about it, it used to be added back because that was a non-business deduction as part of your standard deduction. But now that's gone. Personal and dependency exemption, even as part of the CARES Act extension of NOL rules, exemptions are still out of the picture. The NOL, it doesn't get impacted by exemption. So that's gone. Now, I talked about the excess capital losses a couple of sessions ago. The reason for this, the intent was to limit deductions for non-corporate taxpayers, i.e. your individual shareholders. The cap initially was $500,000 for married and $250,000 for other taxpayers, single head of household. Index, of course. So for 2020, it was indexed to inflation to be 259 and 518. Those were the inflated amounts. But it's actually kind of funny because the CARES Act repealed that whole particular section. So that's in your book, but I also want to tell you that the CARES Act repealed that, so there is no limitation. So individuals that have losses from different business activities, they could pretty much write it all off and create an NOL. Under previously, whatever the excess is, up to that point, whatever is disallowed would be part of the NOL computation. Now this whole section is gone, not part of NOLs anymore, or not an issue at all. So why am I talking about it? I don't know if it'll get resurrected again. I don't know. It's been repealed as it stands right now. They might look back in the future and think, well, maybe this is a way to generate revenue for the government. I don't know, but as it stands right now, it's been repealed. Not temporarily, it's just been repealed until it gets addressed later. All right, so those are the losses. Let's just go over a net operating loss problem. All right, net operating loss problem. Are you guys ready to do the NOL problem? Sure you are. What's the tax deduction? Here we go. So in my problems, I actually did it backwards just for fun. I started with the NOL instead of doing vacation home. So the vacation home is actually all the way at the end, which we already did. All right, so figure out determine adjusted gross income, taxable income, and so forth. I'm gonna do it here. Again, but I'm gonna count on you. So I'm a broke. That's a joke. She's single. She's an underemployed instructor. She works for City Colleges of Chicago. Doesn't get paid much. I'm kidding. I shouldn't have said that. This is being recorded. Well, educators don't make that much, so that's not, a lie. So Amber works as a part-time instructor, and this is usually what happens with part-time instructors like myself. We also have our own business or other sources of income. So it is common for an instructor to have other source of income. So I'm a broke taxpayer. Has a consulting business, and this she devotes significant time in. The reason why I mentioned the significant time in because that's important as it relates to net operating loss. I'll go over the material participation rules in a few minutes. But technically speaking, you got to materially participate in the business in order for you to be able to deduct a loss. If you do not materially participate, then it's considered a passive loss, which is not allowed. Which we'll go over that in more detail when we start covering, the passive activity rules. That's why I added the significant timing because that's actually relevant. Ima had the following information for 2018. She had salary from a part-time job of $20,000, dividend income of $2,000, gross income from the business, consulting business, that's $50,000, and then the deductions from the business consulting business is 125. Itemized deduction is $10,000. I forgot to tell you, we're doing it for 2018. It doesn't change if we do it for 2019. The NOL is going to be the same number. So standard deduction is for 2018 it was 12,000. All right, so we got to answer these questions, but let's. I know I remember step one was what? Compute. Forgot. Can somebody help me remember what step one? Somebody. Hold on, I'll pick on somebody. Wait, don't go anywhere. Lawrence, are you here? Are you here, Lawrence? Remind me to call on Lawrence later. Hannah, you're here.
Yeah.
All right,
Would
what's
this be compute net loss from business?
yes, net loss from business. But pretty straightforward. Yeah, very good. Business. And then step two would be I'm gonna do step two and step three together. That's compute AGI and taxable income. But you're right. It's and then step three, compute NOL. So Hannah, you're right about this. So we got to figure out the net operating loss. So let's business. I'm gonna abbreviate revenue, which is how much? 50,000, right? Minus 125, right? What does that equal? 75,000, right? So 75,000. So what do we do for 75,000? Is that the NOL? No, right? Step number two, compute the adjusted gross income and compute the taxable adjusted gross income and taxable income. So what I'm going to do, I'm going to cross these out. We already used this straight through. So when you're doing this, sort of strike it out. We don't need that information anymore. So what's left over? Salary, dividend, and itemized deductions, right? So we got salary, right? Salary, that is $20,000. What's next? Dividend. That's $2,000, right? Net loss, biz loss. And that was 75,000, right? And that takes care of everything. That takes care of, so this is gone, this is gone. So the only thing we have itemized deduction or standard deduction. So in this step, what can we figure out now? What's the next step? It doesn't let me do an underline. Well, you guys get the gist of it. So we can figure out AGI here, right? Oh no, it's acting up again. Okay, AGI. What would be the adjusted gross income here? Somebody with the calculator. What? Yeah, negative 53,000. I hate it when it does this. You're kidding me. All right, I'll finish this problem and then I'm going to switch over to the other computer. So AGI is 53,000, right? What do we subtract? Standard deduction, right? I'm just going to type the numbers. It's not letting me type the extra letters. I'm going to have to restart it. So what's the standard deduction? 12,000, right? Taxable income in this case. What's taxable income?
65,000.
Okay, is that our NOL?
No.
No, that's not our NOL. Thank you, Mia. All right, you want to take a stab at this, Mia? How do we figure out NOLs? I'll give you a hint. We start out with I wish it didn't act up because it's, try to follow it this way. We have our taxable income at 65,000, right? Everybody agree with that? Everybody okay with that? All right, Mia, what's the next step? And we add something. What do we add? Add NBI, right? Or NBD. Non-business deductions in excess of non-business income. What's from the information on top? What's non-business income? 2,000, right? You guys see that, right? Again, we talk about what's not part of active income, whatever not part of category 1, whatever is not active. So dividend income, what category is that? Portfolio, right? So that's non-business income. What's a non-business deduction?
The standard deduction?
Very good, standard deduction. So we're actually adding back only $10,000. So NOL is negative $55,000. Can somebody tell me how we got the $10,000? Again, the NOL is $55,000 for this problem, but how did we get $10,000 as our add back? We add back non-business deductions, which is $12,000, right? Minus your non-business income. So again, non-business deductions in excess of non-business income. So what do we got? $12,000 minus $2,000, that's $10,000. What is our NOL? $55,000, right? And that's part of we got A, B, C for that one. We don't have, letter D. Any questions so far on this stuff? Because I'm gonna start the laptop and then just switch over to the other computer. Any questions? Well, before I switch over. No questions?
I think quite. Can you for the 10,000? Can you write out the values that you added and subtracted next to it?
Well, it's 12,000 minus. You're kidding me? That's not even. It's not. The minus is not even working. How about less? That's not working either. So it's in the 2,000. That's it. It's those two numbers. Think about it, class. What's non-business deduction? $12,000, right? What's non-business income? $2,000, right? So $12,000 minus $2,000, that gives you the $10,000 add back. So the NOL is $55,000.
So the salary is considered business income?
You didn't hear the part where I said, remember when I said, I'm sure I gave this to you. Remember when I said the business regarding the business, when you're dealing with business income, what are the 3 categories of income? Matt, I'm asking you. I said this is in part of the presentation.
Passive, like portfolio. I can't recall the other 2 right now. Sorry, my memory's not great.
Okay, well that's fine. You just I only need 2 for this. salary is part of what category,
Active.
right? It's not. Is it part of? Think of it this way: is salary part of category 2? Category 2 is non-business. Remember, I said category 1 is business income, earned income. Category 2 and category 3 would be non-business income. So let me ask you again: is salary part of category 2 or part of category 3? I'm asking everybody. What do you guys think? Is salary part of category 2 or part of category 3? What category is salary in? The first category, right? The earned income. So that is part of the computation for the NOL. And I'm actually glad that you asked that question, because think about this particular answer. NOL somehow came up to be $55,000. And I want to tell you this, that it doesn't always happen this way. Sometimes it does. And this is just sort of by coincidence in a way. Not really, but sort of by coincidence. Remember, the NOL is $75,000, right? How much do we have in salary? $20,000, right? So think about your active income. We have salary, $20,000, and this is active income, right? Even though it's a loss. So total active income, if I were to ask you a question, what is your total active income in this case? $55,000 negative. Does that number sound familiar? Isn't that your NOL? This is one of the reasons why I designed it this way, so you can sort of get the gist of it. That is the NOL. If you think about it, it's sort of the core concepts in a way. It's sort of not always true, but in a lot of cases it does allow you to offset the salary against your net operating losses, because both of them have the same elements. Again, what are the buzzwords? The big buzzword when we talk about active income, we talk about that being earned income, right? So in essence, it's you have a business income. Business income is also your earned wages. You materially participate that to earn your wages, so that's part of your business income. So yeah, it's $55,000. But again, this is just by coincidence for this one. It doesn't always work out that way. It's sometimes we do more steps and get a different answer. Any other questions on this part? Yeah, there are questions in chapter 7 that we'll get into in a few minutes. But let me hold on. Well, I'm going to reboot my computer very quickly, but at the same time, I want to keep the conversation going, because this is I did not update this question, but answer this question. Start thinking of the answers for this particular question. Describe the options IMA has for net operating losses that incurred in 2018. So start thinking about that. What are the options that she can do for losses that would happen in 2018? So I'm gonna put my microphone on a different computer. Do you guys hear me? All right, hold on.
Yeah.
All right, so I have two mics here. So what I'm gonna do, I'm gonna switch over the mic, and you're not gonna see me when I switch over to the other computer, but I'll still be talking. This is gonna give me a couple minutes to reboot my computer. It's, as far as I know, it should still record because I have myself as the co-host. And if for some reason it doesn't, I'll just
Indicating that it's recording.
okay. Let me reboot. Okay. All right, let me reboot. I'm leaving meeting. Okay. I'm assigning. Can you guys hear me?
Yes.
All right, thank you. Let me restart. All right, so let's talk about the NOLs that IMA had for 2018. So what can she do with that $55,000?
Uh,
What do you guys think?
she can carry it forward or carry it back up to 5 years.
Okay, as part of what? What is the act that extended that?
The
CARES?
Yeah, that's the part of the CARES Act. Something else that the CARES Act provided. That's true. 5 years of carry forward forever, I guess. But what else is good about the NOLs for 2018, 2019, and 2020 under the CARES Act? What do you guys
Can
think?
offset 100% of the taxable income.
That's the big one. It can offset 100% of the taxable income. Because it can offset 100% of the taxable income, I guess the other side of it, it's not generating any revenue for the government. So it's, that's a provision that favors, the taxpayer. So good for the taxpayer. It's an excellent provision. NOLs that occurred in 2018, or actually no, NOLs that occurred in 2017. I was just gonna say, would your answer change if the NOL happened in 2017? What do you guys think? Would it change? How would it change? Well, not so much will change. If the NOL happened in 2017, part of what you said is still true, right? Except the carryback was not 5 years. It's how much? How many years? 2 years,
2.
right? Yeah, 2 years, and then carry forward 20 years. So that's in case I asked. Okay, I'm back. Let me. Sorry. Hello. All right, I'm back. I think. Can you guys hear me from this computer now?
Yes.
All right, good. So it turned out okay. All right, so let's go back to. All right, so regarding NOLs, any questions on NOLs?
Can you just reiterate what that for D, the option she has? I'm not as clear on that.
Oh, yeah, I'll get back to that. Well, I'll just show you I'll show you the answer right now. So option D, reiterate. So again, keep in mind that the NOL happened in 2018. So I guess it depends on if I would have asked you this question at the beginning of the year, the answer would have been different. But if I'm asking you this question now, and that's what the question, and most people that answer the question correctly, that's how they formulated their answers. So I'll show you the answer according to my lecture notes. But just keep in mind, again, old rule, carry back 2 years, carry forward 20, but that doesn't apply anymore. But that's part of the old rule. The reason why I gave you part of the old rule as a review, I wanted you to at least understand where the thinking was behind it. CARES Act, provided some temporary release for NOLs that happened in 2018 and 2018, 2019, and 2020. I'm going to share the screen too. You guys can see what I'm referring to. In 2018, here we go. So this is what I think I really just cited right now. That because of the NOL that happened in 2018, this is actually what I was looking for in terms. If I were to ask you this question again, the answer that I was looking for, you see what I'm highlighting here? This is the core of it. As part of, actually, that's not it. Sorry. Because the CARES Act. Again, it's a bit of the old rules. The NOL can be carried back up to 5 years. And then you could offset 100% of your taxable income. not 80%. So that's actually good for NOLs that happened in 2018, 2019, and 2020. So that's the answer I was looking for. Now, let's say if I would have asked this question, so let me say let's say hypothetically speaking, you were in my spring federal tax class before the CARES Act was even passed, before they even thought of the CARES Act. What would have been your answer if I would have asked you that question? Same question. What are the options IMA had for NOLs in 2018? And this would have been your answer, right? NOLs are carried forward, but they can only offset 80% of your taxable income. So you do got to be aware of both. But for the purpose of my final, understand the new rule. Even though the new rule is not in your textbook, I do want you to know the new rule. Carry back 5 years, up to 5 years, and carry it forward indefinitely, and you can offset 100% of your taxable income. This is generating the cash flow for the taxpayer. This is actually very good. That is going to be part of the question. This is what I want you to answer. Now, if you want to start talking about the old law, that's fine. I mean, I'm not should say old law. As part of the Tax Cuts and Jobs Act, I guess you could include that. But what I was looking for is more of this, because this is more practical. Even though this is not in your textbook, this is what's being used now. This is benefiting clients. This is going to benefit taxpayers. This is what you want to use. Again, they can carry back 5 years, try to get refund 5 years, and that way they can use Form 1045 and 1139. So speaking of which, since we're on the topic,
I actually had a question.
well, hold on, no, hold that question for a second. So since we're on the topic about carrybacks and carry forward, let's sort of think about the carry back provisions or lack thereof under the Tax Cuts and Jobs Act. There was no carryback, right? So this is what's just some thought among the practitioners. It would be reasonable for us to believe that these forms 1045 and Form 1139, based on the language as part of the Tax Cuts and Jobs Act, these forms would tend to be obsolete for at least NOLs that happened in 2018, 20, and going forward. That was our initial thought. But because of this change to allow the taxpayers to carry it back, we no longer think that way. We change our minds sometimes. All right, go ahead with your question.
For the 2017 and previous rules, the NOLs could be carried back but applied to the earliest year first.
Right.
Is
But
that also the case for the 5 years?
yeah, that's also the case for the 5 years. You do got to carry back. So that's what I mean with some of the old rules. So yeah, it's to the earliest year first. Um, so yeah, it's you got to carry back to the earliest year first, to the extent that there's taxable income. So keep in mind that if let's say taxable income, was zero in the fifth earliest, or first earliest, depending on how you look at it. Then you're going to carry back, you know, to the fourth year and so forth. So yeah, that's part of that's a good question. That's part of the law. Also not listed here, the election to forego the carryback. I should have put that in here. That's part of the CARES Act. So yeah, not only did it have because that's again, remember I said that some of the old rules you got to carry it back, 5 years. So that's the provision, carry back 5 years. Again, if you look at the numbers, it's still going to be, it's going to be 17, 16, 14, 15. You're going to look at it that way, but you got to do the earliest year, 15, well, 14 first, and then 15, and so forth. You got to do it that way first. Yeah, that's a good question. So it's, again, that's what I mean is part of the old rules. It's always been that way. So that's, yeah, you got to do NOLs, but just think about that, the question you just asked. Doesn't that benefit the taxpayers? Let's think about the statute of limitations. What's the statute of limitations for refund? 3 years. Under old tax law, the 2-year NOL carryback worked because that was part of this 2-year, limited to the two-year whenever the taxes were paid. That's part of it worked with the statute of limitations. So the 2-year statute of limitation worked. Now, as far as the 5-year statute of limitation, I mean, it goes past the 3-year statute of limitation. So another reason why you should use Form 1045 because of that. But what probably will end up happening if you try to amend the tax returns for all 5 years, they're only going to accept the last 3 years. Much better doing it in Form 1045. Even though procedure that you're supposed to do the last 5 years, they may, somebody just processing the return, they're just going to know it's past 3-year statute of limitation, even though this 5-year rule is there. Again, better procedure to do 1045 or 1139 if it's a corporation. But yeah, good question. And yes, the earliest year first, forego is still allowed. Yeah, I guess the other option would have been, it would have been okay to, I still think it works for the taxpayers. They can, in essence, get refunds for those 5 years to the extent that there was taxable income. Again, if there was no taxable income, then there's nothing to carry back in that particular year. So it's giving, so that's actually very good. And one part that I'm not telling you about in terms of refunds, so remember I said if you're getting a big refund, let's say $10,000, $20,000 refund of your withholding, they're giving it back to you interest free, right? Which is not always good. Is there any situations where the federal government or the state government gives you interest on top of your refund? Could that be a possible? So they don't pay you interest when you're lending them money. Not in that fashion. If you want to be patriotic, invest in bonds. They'll give you interest on that. But in terms of interest on refunds, is there any situation that you would get a refund on an interest or interest on a refund? State refund, federal refund. What do you guys think? Yes. They're supposed to pay you back the refund within. Usually, it's not the 2 weeks that people say. It's actually within 45 days. More specifically, it's within 45 days from the due date. And they actually have within 45 days from the due date, April 15th, to give you a refund. Anytime before that, at that time period, they're not required to give you interest. Now, if it passes 45 days, they're required to give you interest. That's from the due date. So think about the original due date if you're carrying it back 2 years or if you're carrying it back 5 years. Guess what's going to happen with that refund? The NOL is not just going to be the tax liability, the taxes that they paid, and that's what I want you to at least think about it. So when you're having these conversations with your clients, at least be aware of it. Tell your clients there's more likely than not that you're going to get interest on top of the refund. So let's say when you do your 1045 form, you're computing total refunds for total years would be $12,000. There's going to be interest on top of that. So it's not going to be $12,000. It's probably going to be more like $13,000, more or less. Again, I'm just, throwing numbers just for the sake of this conversation. The difference would be interest. Next question. Is the interest on refunds taxable? What do you guys think of that? Is the interest on either a state refund or a federal refund taxable? Anybody want to volunteer an answer?
I'll guess that it is taxable
Yeah.
for a state, but not for federal.
Cite the authority for that,
Well-
Don't have one.
because there is none. Isn't there an authority regarding what's the only interest that you can exclude? Only interest that you can exclude. Everybody
Isn't
should
that
know.
an
State and local
municipal?
bonds.
State and local bonds. This is not
Everything
state-
else is taxable.
Everything else is taxable. Very good. Everything else is taxable. Look at it, that way. Remember we sort of talked about, core concepts of income. Everything is income unless there's an exclusion that tells you otherwise. It's true for anything. Think of interest. All interest is taxable unless it's not. What's the only interest that's not income? Municipal bond interest. I want you to start thinking of that because it's actually if you start thinking that way, that's usually how tax law works. Try not to overthink it. Try not to apply laws that don't even exist. Again, with something like this, I was actually surprised. I should have expected more people to say, "Well, only municipal bond interest is excluded." Because that's like the only answer that's excluded. And I was even hinting you on what's the only interest that's excluded. It's municipal bond interest. Think of it that way. Same thing for like capital assets. Because we talk about capital assets in a lot of detail, same process. So if it's not on this list, if it's a capital asset, so it's sort of thinking of it that way. Cryptocurrency, that's a capital asset, right? Because it's not accounts receivable, it's not inventory, it's not a fixed asset. it's a capital asset. So again, just start looking at it this way. It's all income unless there's something that tells you otherwise. So let's say one of the examples that I do walk through several times during the semester, and I'm sure everybody would get the answer to this. I usually say this on campus, but I'm not on campus. But let's pretend I'm on campus. Actually, no, I'm in my office. Let's say I'm in my office. I've been commuting on my bike for since the coronavirus started. I've been just it's actually been pretty good. So let's say on my way home, I go through the forest preserves. All kinds of people go in the forest preserves. Let's say I find a bag of money, in the forest preserve. Let's say it's $1,000, $100, whatever it may be. Is that income to me? Everybody should know the answer to this one.
Yes.
Yes, absolutely. Again, unless there's a provision that tells you otherwise, it's considered income. Now, I get it. From a practical standpoint, how many people are actually going to report that? It's something to think about. But just also keep in mind that it's all on materiality, which you've learned about materiality in other classes. Now, if it's $1,000, probably unlikely the IRS is going to audit me. But let's say if it was $10,000. Well, let's say I had $10,000. Most likely, what am I going to do with that $10,000? I'm going to deposit it somewhere, right? There's a proof that I received some source of income. Eventually, let's say I get audited, the IRS is going to ask for my bank statement. There's a $10,000 deposit, or let's say I was trying to be slick. I'm only going to deposit 909 or 9,900 one day. Wait till next week and then deposit the other 100. Try to be slick that way. Well, it still shows up as $10,000 of untaxed income. Unless the IRS knows, what are they going to infer that income is? It's income. So just be careful with that. If it's traced somewhere, it's going to be considered income, and they will look at my bank statement. And considering the materiality, I should report it. What has happened to me, and it's the reason why I sort of do the example for on campus, or even in the woods. Sometimes you do find, like, $20 or $10. Is that considered income? Yes, technically speaking, it is income. But what are the chances somebody, one of your clients even, reports that on their tax return? $20, $100 that they found here and there. What are the chances that actually happened? What do you guys think? Slim to none, right? It's very unlikely that they're gonna report it. Now, again, in this class, we're focusing on the actual law. Now, if it's practical, again, small amounts, the IRS is not going to come after you. Now, what are you telling your clients? You're telling your clients you're supposed to report all the income received. Period. If they choose not to tell you that information, that's on them. But if they tell you that information and you tell them not to report it, you're aiding and abetting the preparation of a fraudulent tax return, even if it's $10. Of course, again, they're not gonna, probably not gonna discipline you on that, but it's the principle behind it. Because sometimes, what happens with, when you commit one act of fraud, then you'll do another one, and another one, and so forth, and then you forget that you committed a crime, and now you're in jail. But that's neither here or there. All right, any questions on NOLs? Because we're gonna start getting into more details on business deductions. All right, you guys ready for a continuation of the next problem? 7. All right, the next couple, the next, wait, sorry, I thought you had this. All right, here again, this is a continuation of the tax deduction problems. A lot of this stuff we've already went over. NOL, specific business deductions. We'll talk about that in detail in a few. Guess what we're going to talk about today? Qualified business income deduction. We did talk about that briefly before. We're going to get tax depreciation. We're going to start with that as well today. We're going to do a problem today with tax depreciation. Take a look at those articles. There's more articles on the CARES Act, but I haven't updated it. There's more articles. All right. Remember that BHIP mnemonics? Just revisit that. In terms of, again, a lot of this is just a review of stuff that we covered previously. Hobby and activity business deduction under Section 183. Remember, hobby expenses are limited to hobby income, but you can't deduct hobby expenses because those expenses are temporarily suspended. But what I want you to, take away from that is this rule under Section 183, Section D. No paragraphs, just subsection D, 183D. It talks about if you have 3 out of losses in the last 5 years, the IRS can reclassify that and treat it as a as a hobby activity. Now, regarding that, the burden of proof in that case would be on the taxpayer to prove it's a business activity. Business records, accounting records, business plan, marketing plan would substantiate that you actually have a business. So again, you would have to show entrepreneurial effort, even though it lacks profit. You have to show that there's entrepreneurial effort. But again, client list, receivables, again, show them your accounting system. Yeah, Section 212, again, limited to income from the related income. These are usually attorney fees, but these items are no longer deductible. Now, regarding the production of income deductions, now I put this in here sort of to revisit this particular point. If I'm, let's say again, let's say I have a sole proprietorship and I hire a lawyer to collect one of my delinquent accounts. Technically, that's actually a production of income deduction under Section 212. It is a production of income deduction because I'm collecting income, but because that's business related, it's deductible under Section 162. So just think of it that way. Any business expenses or any expenses that relate to collecting business income, like again, you're hiring an attorney or court fees that relate to you collecting a delinquent account from your business, or maybe you're hiring an attorney to that relates to a delinquent tenant. In that case, that's considered a Section 162 deduction for HEI, not a production of income deduction that's no longer deductible. Again, and that would be deductible either on Schedule C or Schedule E, depending on the situation. We talked about personal expenses. There's no deduction for personal expenses, except itemized deduction and tax credits and HEI deductions. Section 162 in a nutshell, it must be ordinary and necessary. Again, charity is not a business deduction. It's a personal deduction, but not a business deduction. Legal bribes cannot be deducted, even though you may give bribes to a government official, not deductible for tax purposes. Fines and penalties. So if you're hit with a penalty for filing a tax return late, if you're hit with a fine, get your license suspended. If you get a ticket, traffic ticket, speeding ticket in the course of doing business, not deductible. Lobbying and political contributions, not deductible. 50% of meals, not deductible. Well, there's an 80% rule. 80%, well, 80% deductible for Department of Transportation jobs. We'll go over that in more detail. Think of this as interstate commerce. So your truck drivers, they're if they travel state to state, they're able to deduct 80% of the meals. Pilots, because it's interstate commerce, again, they can deduct up to 80% of the meals instead of 50%. So they have a higher threshold in terms of what's deductible. As we mentioned, 100% of business entertainment is no longer deductible. Now, we did talk about startup expenses. Again, this is just us revisiting startup expenses. Startup expenses are deductible as follows. You deduct the first $5,000 and then amortize the rest over 180 months. We talked about the phase out provisions. It starts to phase out dollar for dollar, and when your startup expenses exceed $50,000, it completely phases out at $55,000. In that case, it just gets amortized over 180 months. That's pretty, straight basic on the startup expenses. Again, what we're talking about now, we're not going to talk about all business deductions. We're going to talk about the more common business deductions. But just keep in mind on what's deductible. It must meet the ordinary and necessary business expense. So I get asked this question a lot. I'm in X business. What can I deduct? And it actually baffles me sometimes because I'm like, what do you mean? I don't know what type of expenses you have in your business. The best I can answer is it's ordinary and necessary. And they look at me like, what does that mean? Think of it that way. What do you need to operate your business? Do you need tools to operate your business? And then, yeah, that's deductible. Do you need equipment to operate? Then that's deductible. So think of it that way. If it's ordinary and necessary for your business, again, what do you need for operation? Then it's deductible. And it's actually pretty funny because then I start telling you, well, maybe it's better for me to tell you what's not deductible. Then I give them a list of what's not deductible. And that's I don't think that that's what really they're asking for. Um, Sometimes people want us to fabricate deductions. That's not what we do. Preparers use the information provided by client. When they ask what's deductible, you just tell them your business deductions, so long as they're ordinary and necessary, and they're not charity, bribes, fines, lobbying contributions. Then it's deductible. So long as it's related to your business. Personal expenses that you run through the business are never deductible. So let's talk about a common, what's popular out there in terms of business deduction. Transportation expenses. So that is pretty common for a lot of businesses. Business transportation may be deductible. Commuting transportation is never deductible. So the distance between, even if I go on my bike, between my house and here is not deductible. Actually, now that I think about that, so if I'm meeting clients on my bicycle, the distance on my bicycle from here to wherever I meet clients, that's deductible, right? Now, granted, I'm not going to do that. I'm going to go on my car. It's much more convenient in my car. But technically, that's the business. Again, the distance between my house and here, that's considered, commuting, right? And then the distance between my office back home is commuting. That's never been deductible at all. The distance between my office and wherever I'm meeting clients, that's deductible. If I have a second job, then that increases the range. I can deduct the distance between my first job and second job. And then what if I go meet clients? Same thing. The distance between my first office to whatever the client is, that's deductible. Out of town travel is a bit different, and then it's pretty much 100% deductible if it's out of town travel. Again, if it's related for business, if it's 100% related for business, then 100% deductible. If it's less than 100% related for business, then you just prorate it. But when it comes to auto, it's just the business mileage that's deductible. Now, there's two ways you can take the deduction. It's either the standard mileage rate or the actual cost. Now, the standard mileage rate, you take the standard mileage, whatever the rate is, I mean, and then your business mileage, multiply it, and it's 58 cents per mile in 2019. I didn't put the 2020 number. Actually, I think 2020 is the same, if I'm not mistaken. Let me double check. They don't really change much. It's been about 50 cents or so for the last few years. Considering the price of gas did go down, uh, yeah, I would say it should stay about the same. It may even go less next year. We'll see. Nonetheless, this is driven by inflation, and it's 58. I'm pretty sure it's 58 cents 2020, or the actual expenses. Actual expenses, you're just going to prorate it. Business mileage divided by the total mileage and times the total actual expenses. What's included for total actual expenses? It's pretty straightforward. Gas, repairs, insurance, depreciation, registration, that type of stuff. Now, one thing I want you to think about regarding actual expenses. Can somebody write off car payments as a deduction? No. Can somebody write off mortgage payments as a deduction? No. What's deductible when you buy a car? If it's business related, well, the depreciation. Think about cost divided by the useful life. Insurance, interest. That's deductible, but not the car payments. The car payments alone are not deductible. Of course, the car payments does include this indirectly, but the car payments alone is not deductible. You will need the original cost basis or the fair market value to figure out what the depreciation is. So let me give you an example. Oh, and by the way, both methods include parking and tolls, either the standard or actually you're still going to add parking and tolls. So here's my example. IMA has $10,000 of business. Actually, no, scratch that. Now, $15,000 of business mileage and $20,000 of total mileage. Total actual expenses for her auto are let's just say total was, I'm just gonna say $10,000. Again, I'm picking round numbers just to so you guys can see. But if you think about it, these will not look. If you use these numbers, this is like asking the IRS to audit you. So let's use the standard mileage method. Standard mileage mileage is going to be what? 15,000 times what? 0.58, right? And what does that equal? So we're doing 15,000 times 58. That equals 8,700, right? But we have to see if actual is better. So actual, so the actual is going to be the ratio of 15,000. Oh, it's going to be the ratio of 15. I'm going to say 15K over 20K. You guys see where I got those numbers from, right? Again, I'm taking the ratio of business mileage over total mileage times my actual expenses of $10,000. I should come
Could-
up with
Can you
7,500.
scroll down just a little bit?
Oh, sorry. If my math is correct, that's 7,500, right? Did I do that right?
Yep.
15 divided by 20, 75. Yeah, 7,500. Which one is higher?
Standard.
Standard mileage. I want you to get in the practice of going through all of it. Some clients will say, well, "Can I do both?" No, you can't do both. It's either or. You can't do both. Either the standard mileage rate, which in this case is higher, or actual expenses. Sometimes the actual expenses can be better depending on the depreciation, and depending on when they put the vehicle in service, it may actually be better. It all depends. What I will tell you, in most cases, if it's more than 50% for business, and if it's a newer car, chances are most likely actual expenses would be higher because it's a newer car, and that the way the depreciation schedules work now, it favors taxpayers that are buying new cars. If it's an older car, used car, maybe standard mileage may work because there's not much depreciation to work with, and other expenses to work with. So again, it all depends. It's on a case by case basis. One thing I want to ask you: auto expenses get audited a lot. I mean a lot. When I say a lot, I mean if you put it, make sure you have support. That's what I'm trying to have you understand. Um, it all boils down to that. If somebody gives you mileage, now $15,000, that's a round number. You may want to ask, do you have support for that? You have to ask, do they have support for that? What if they tell you no? Then you're supposed to tell them, why I can't put those expenses if you don't have support. And it's very simple to get support. I like to recommend Mile IQ. So again, there's apps like Mile IQ and QuickBooks. There's other apps, Expensify. Well, anyways, there's Expensify, Everlance. There's a lot of tracking apps can track mileage, and a lot of these are free.
Is,
So and you can even put it in Excel. So I really don't see why it's really that much. Why a lot of people don't do that. And I've even had clients that actually have it on an actual manual or old-fashioned. They write down the mileage, and that's detailed. The mile log. So you have an idea. Mileage log is pretty. It's the mileage log is the purpose of the meeting. Who you met with, and the mileage. Then add it up, and that's your mileage. The thing is, because this gets audited a lot, very few people keep their mileage. You won't believe how many times I've had this conversation with the client. Well, can we use what we did last year? The previous tax return preparer always estimated this. What do you think I say when it comes to that case? Well, I'm supposed to use the information that you give me. If you told me to use the same mileage, I need you to tell me that. And I'm also have to remind you that you have to have support for this for your deduction. And usually I get the response, well, I needed support. And I'm like, oh my. And then I usually show them, well, let me show you where on the tax return that you signed off that you actually were aware of it, that you needed support for that. And yes, there's a question for it. Do you have support for the auto expenses? Yes, you checked yes. Is this support in writing? You also checked yes. And now you're telling me you weren't aware of it? Again, our job is not to audit the client. Our job is to ask questions. If they tell you yes, then take their answer. If they tell you no and they still want you to do it, you're aiding and abetting the preparation of a fraudulent tax return. I would not. I don't feel comfortable putting my name on a tax return that way if they don't have support for it. It's almost like they're asking you to lie, and that's not the type of reputation that I want you to have. Because again, it does get audited a lot. Meals and entertainment, again, deductible up to 50% and 80% for Department of Transportation work. Again, think of interstate commerce. Guess what? This also gets audited a lot. And by a lot, okay, I'm kidding. I'm not going to go through that again. Same principle here. This is all under the same rules. Meals and entertainment, because everybody goes out a lot, and then they say, "Well, I'm going to write this off. I want to write that off," and sometimes they shouldn't. And it's pretty simple in terms of what you can actually write off. It's a business meeting. So long as your client knows that you're going to discuss business, you don't have to discuss business the full duration of the meeting. I don't know if I gave you this example before, but I have a friend of mine who's a client of mine, but we'll go out, we'll have, meetings. We're always talking business, but we also talk about sports, politics, current events. And that's usually sometimes, he'll say, I have a tax question. And he does have a tax question, but sometimes it's a ridiculous tax question, like something like, well, my wife and I are thinking of having kids. Can you please explain to me what are the tax ramifications that we have another kid? And he knows I'm going to get into detail. Well, considering that, the child is under age 17, you get the child tax credit, blah, blah. But then I go into detail, and that's usually what he wants to hear. Most of the times, it's more specific on, well, I'm thinking of buying another property, stuff like that. Again, it's usually well documented, and there's proof of that. What I've always told him, just like I tell anybody else, and he has my contact information. He's like, just you're speaking with me. There's proof of that. In terms of your receipt, a good way of keeping track of your receipts. Ask for the business card of the person that you're meeting. Attach that business card. Ask for two actually. One of the business cards would be attached to that receipt. So on the receipt, that's more substantiation that there was an actual meeting. So this guy has a lot of my business cards. So now I'm starting to wonder if he goes to all his meetings and just attaches my business card because he's supposed to have a meeting with me. Now I'm starting to wonder that since he does have quite a bit of my business cards. But you guys get the gist of it. It substantiates that we actually met. But again, that this does get audited a lot, so make sure you actually support it. Most people that put meals and entertainment, they estimate and they write off everything more than what they should. Entertainment is no longer deductible. That's 100%, not deductible. A couple of things about meals and entertainment. We talked about. Hold on. In terms of meals and entertainment, just one question I was going to ask. If let's say I have a holiday party, well then in that case it's not subject to the 50% rule. It's not limited. It's to some extent, that's going to be unlimited, generally speaking. All right, go back to your question.
For the mileage question, for the mileage log, do you have to record total mileage for a trip or starting
Yes.
mileage and ending mileage?
You got to do total. Well, keep in mind right here, I need total mileage for the whole year,
I'm
right?
talking about I go from my office to lunch to meet with a client and then drive back. Do I
Okay.
need to know the mileage on my car when I first left the office and when I returned to the office, or do I just need to know like the miles I traveled?
You need to know the business miles.
Okay, so it's the miles more so than beginning and starting for each of them. This was related to a
Well,
question I had. At one time, I was looking to deduct these costs before deciding it was far too much effort for any kind of return. It was that I knew what I had done on each day, but I had not recorded the mileage in the car, and I wasn't sure on that.
Well, it's you should do that if you have record of it. You should do that. But well, I guess the initial question, I thought you were going to ask this question because well, this is what some people do, and this is how they estimate. Well, my beginning mileage was in my car was 12,000 whatever. The ending mileage at the end of the year was 24,000. So I drove 12,000 for the whole year. Of the $12,000, of the 12,000 miles, half of that is business. I'm serious. This is how some people come up with their business mileage. And think of that particular method. Is that a good books and records method? No, that's not a good any kind of method. That's just estimating. Now, I think that you were doing it more from a day's perspective, which which would in your case it would actually be better because you're trying to track back your actual business days, and that's fine. But if you're trying to do that for the whole year, it's not no. Now you're trying to just fabricate the numbers. A lot of people do that. Okay, I know I met with so and so, this week. These are my business miles. Now, in terms of what's my total mileage, well, I'll just take my total mileage for the whole year. All I got to keep track is business miles and see, what works. In
Right.
that case,
That's
if,
just time your oil change for the start of the year.
yeah, and I was just going to suggest that you read my mind. Just time it at the beginning of the year, and that way you have the mileage, and then you can estimate your total, and that's your total mileage. All you really got to keep track is your business mileage, and that's it. And then in that case, because the thing is, they're not going to audit your total mileage per se. They're going to audit your business mileage. Just keep that in mind. However, now something like this, keep in mind that this is 75%. Anytime it's more than 50% that you're using your auto more than 50%, and again, some jobs do, are required for you to use it more than 50%, but it's more than 50%, most likely is going to get audited. The closer you are to 100%, it's most likely going to get audited. That's not to say that there's no, there are, and I have clients that use their car 100% for business. They're salespeople. I see, salesperson, they do use their car 100% for business, pretty much. As long as it's substantiated, I asked for their mileage log. They gave me their mileage log. It's there. I'm like, okay, that's fine. We'll put it on the return. It works. Any other questions on mileage and auto expenses and meals? Again, we got quite a bit of stuff to cover. All right, how home office expense. The only thing I want to tell you regarding this, similar rules to vacation homes, is under the same code section, section 280A. Remember, under that code section, it's again basic rule. It's limited to gross income. What are the three categories of expenses? The three category of expenses would be what? Three categories of expenses would be, what's the first category? Anybody? First category of expenses. Anybody? Anybody? I'm giving it to you right there. Mortgage, interest, and property taxes, right? Other and depreciation. Now, in terms of what can be deducted, the room itself has to be exclusively used for business, and you just prorate it. Again, it works better if it's like a two-bedroom, condo or apartment. Then one of the bedrooms is exclusively used for business. Then it works. Now, if you bring work home and you're working on your living room, the living room is not 100% used for business. Again, the key word is exclusively used for business. That room itself has to be exclusively used for business, or whatever partition space you're using has to be exclusively used for business. You cannot deduct the living room. You cannot deduct your bathroom or bedroom because that's not exclusively used for business. And then you're only prorating it, similar to what we did with the car. So let's say the room represents 100 square feet. The room that I'm using 100% for business, that represents 100 square feet. And then let's say my total expenses for the whole house, depreciation, everything. It's again, let's say its total square feet is 1,000 square feet, and that includes the total expenses. I'm only allocating 10%, right? So 100 square feet for the room, 10% for the total. And again, the three categories would be property taxes, property interest, property taxes and mortgage interest, other expenses, and depreciation. Again, Mortgage payments are not deductible. Mortgage payments are not deductible. What is deductible? Mortgage interest, property taxes, other expenses, and depreciation. Same thing you do here. Whatever is not allocated to the business portion is not deductible or is treated as personal. So just remember that core principle. Whatever is not allocated to the vacation home is personal. And what's the only thing you could deduct for personal? Mortgage interest and property taxes. Same principle here. Let's talk a little bit about education rules as it relates to business. If you're trying to claim a business deduction for education, the education has to be either improve, it's either improve or maintain your current job skills, or it meets your requirements for the employment. So think of this as continuing education. Continuing education is required for CPAs and other professionals. So the continuing education would meet this requirement. What will not be included in this category? Well, think of a job of any type of education that puts you in a new profession. So again, let's say I'm an accountant and I also want to sell real estate. With the classes that I take to become a real estate agent or a real estate broker, would that be an education expense for my business as an accountant? No. What if I go to law school? And would my expenses related to me going to law school, would that be a business expense for my business as a CPA? No. You guys get the gist of it, right? It has to be related to my business and it's used to improve or maintain current job skills and meet the requirements of employment or the profession. Well, let me actually, take it since we're talking about schooling. Continuing education is pretty straightforward. Again, seminars, that's straightforward, that's deductible. But what about if you want to get an advanced degree? Now we've already talked about, so if it puts me in a new profession, it's not deductible, right? But again, if I go to law school, then it's not deductible. Again, going to law school puts me in a new profession is being a lawyer, and then that's not deductible as a business expense. So just keep that in mind. But let's say, okay, the attorney going to law school is not an option, and because I'm looking for a business deduction. Let's say I want to either get an MBA, a master's in business administration, or a master's in tax. Let me tell you more about my current job. Let's say my current job, my current job skills, I don't have any management responsibility. I'm a tax accountant. What would be better suited in that particular job? A master's in tax. Would a master's in tax improve or maintain my current job skills? Yes. Would it meet the requirements of my employment? In that case, that's part of my continuing education. So yes. So getting a master's in tax, because I'm already a tax accountant, that's improving my current job skill. Why would not the MBA would not work for what reason? What do you guys think? When you think of MBA, what do you usually think of the Master's in Business Administration? Generally speaking, that degree is for what? What do you guys think? Management, right? Now, I made sure that I told you that I was not in management. If I wasn't in management, the MBA will not work. So an MBA will work if you're already in a management or supervisory position. Then your argument can actually be, yeah, that's improving my current management skills. Is it improving my current supervisory skills? But if you're not already in management, an MBA will put you in a new profession. Then there's been a lot of cases on that. So think of it that way. If the degree or education puts you in a new profession, not deductible. If it's part of your continuing education and it's improving your job skills, then most likely it's deductible. As we talk about tax depreciation, that's discussed in more detail later. I'll give you the basics today. But what I want to cover is self-employment tax problems today. We already went over the NOL computation, so I'm not going to revisit this. Instead, I want to talk a little bit about self-employment taxpayers, and there's a big problem that I want to go over today. What is self-employment income? Self-employment income under Section 1402 of the Internal Revenue Code, it's income from activity as a sole proprietorship. So you have a Schedule C, distributive share of net ordinary income from a partnership. You materially participate in a partnership and you have ordinary income that's subject to self-employment tax. Guaranteed payments for services performed in a partnership. What's not included here? S corporation income. That's not subject to self-employment taxes. Only income from a partnership, income from a guaranteed payment partnership. Do the math. At the self-employment tax, I'm going to walk through the steps. Today we're going to go over the problem today, and then we're going to get into more detail. A little bit later next week. You figure out your net income. So think of step number one for net operating loss. Business income minus business deduction. That's net earnings subject to tax. You take that number, multiply it by 92.35%. I'll tell you why how we came up with that number. Well, actually, I can tell you right now. Sorry, 92.35. It's 100% minus 7.65%, right? Why is that? What is 7.65%? I sort of hinted about this before. That's your FICA taxes. Social Security and Medicare. Social Security is 6.2%, Medicare is 1.45%, and some is 7.65%. Self-employed individuals, they're paying the FICA taxes on both sides of it. 7.65% times 2. This is the self-employment tax, 15.3%. But before we do the 15.3%, we got to get a self-employment taxable base. And that's your net income from your Schedule C plus income from a guaranteed payment or distributed share from a partnership. Multiply that by 92.35. That's your taxable base for self-employment tax. We multiply that by 15.3%. That is your self-employment tax. Multiply that by 50%. That is your AGI deduction. So you're doing a couple of things here. Yeah, we're going to walk through this in more detail in a few minutes. We got the problem that we're going to do, but we got to understand the other steps. Now, here are the actual steps, which is it's similar to the net operating loss, steps. Again, more steps. I do want you to know what these steps are. Compute net income from business. Again, Schedule C, right? Schedule C. And then let's figure out self-employment tax. What schedule am I thinking of? What's the schedule that you use for self-employment tax? Anybody know? It's for self-employment tax. Anybody? Anybody want to take a stab at it?
Schedule S.
E. You were close. Schedule SC. So Schedule SC. So you got to do Schedule C first, then Schedule SC. Schedule SC, which is what we just did here. That's Schedule SC. Then figuring out, AGI, so 1040. Qualified business income. We're going to get into that in a few minutes. 1040. 1040, right? And so forth. That's pretty much it in terms of self-employment taxes. Now, think of the business deduction. These are deductions in addition to what's deductible. Your business deductions are part of Schedule C, and we're going to walk through that. And then other deductions that's not part of Schedule C, but are deductions for AGI that's related to self-employed individuals. One half of self-employment tax. That's what we figured out here. So once we do the self-employment tax, you don't net the two. Half of that is your AGI deduction. The reason for that, if you think about it, payroll tax expense is a business deduction for businesses, and that is attributed to half of the FICA taxes. So naturally, it seems reasonable for half of that to be deducted for self-employed individuals. Health insurance premiums, but this is limited to net income from Schedule C. Well, not just Schedule C, whatever your self-employment income is from. Schedule C is usually the form. Contributions to a self-employment retirement plan. We'll get into that today, but that's limited to 20% of net income, or whatever the annual ceiling amount is. It's $56,000 for 2019. That's more than the $6,000 for IRA with the catch-up contributions. A lot more. So this is actually more flexible for self-employed individuals. And then we're going to talk about the deduction on qualified business income. Again, there's quite a bit of stuff. We're going to walk through the problem today, and we're going to revisit it next session, and we're going to revisit it after that as well. So So just keep in mind. Qualified business income deduction. This is what it's for. This is part of the Tax Cuts and Jobs Act. It provides an additional deduction. The whole goal of it, because corporations got a flat rate of 21%, even though there's far more flow-through entities than there are C corporations. That's true. There's more sole proprietorships, partnerships, S corps than there are C corporations. But why is a C corporation got more benefits? That's a different question, different topic, different day. Nonetheless, Congress did try to balance the field, and they added the 20% deduction on flow-through income. So what's flow-through income? Schedule C income, right? Income from K1, from a partnership or an S corporation, so long as they materially participate. The key word is there has to be income. You cannot get the business income deduction on a loss. Let me repeat that. You cannot get the business income deduction on a loss. There has to be business income. So this doesn't work on a net operating loss. If you're doing an NOL, you don't have to do this because it doesn't even apply. This applies when there's actually business income, when there's net income, self-employment tax, and so forth. So this is a deduction from AGI after the standard deduction or itemized deduction. And the business deductions are deducted, again, remember that's deductions for AGI and Schedule C, but this is deduction from AGI. Now, what is the actual deduction? The actual deduction is either 20% of what's called qualified business income for self-employment taxpayers or 20% of modified taxable income. Well, again, we're going to walk through this, over and over so you get the gist of it. For qualified business income for self-employed individuals, it's your net income minus 1/2 of your self-employment tax, minus the health insurance deduction for self-employed individuals, minus the SEP contribution you made. That equals your qualified business income. A lot of times that equals your adjusted gross income. Like in the example that I'm going to go over, that equals your adjusted gross income. What is your modified taxable income? Adjusted gross income minus either the standard deduction or itemized deduction. That's your modified taxable income. Think of it this way. This is your taxable income before we even take out the qualified business income. That's your next step. But there's a phase out. We're going to walk through the phase out in more detail later. Actually, remind me to go over the phase out in more detail, next week. But once the modified taxable income exceeds these two levels, again, if you're single, it's 160,700. Double that if you're married. Once it start reaching that level, we have to limit the deduction. And one thing I do want to, again, I'll walk through this in more detail later. I also want you to think about this. There's specific limitations for individuals that are part of the specific service businesses, such as accountants, health, law, actuary science, performing arts, consulting, athletics, services, certain investment agencies. And this is the other part. Businesses where the business's principal asset is the reputation of one or more of its employees or its owners, which I always thought it was pretty funny. Which doesn't that mean it's all business? So if you're reading it to the letter of the law, then it's saying all businesses are subject to limitation. But that only applies when you're over this floor. Again, keep that in mind. So once you exceed these floor numbers, 160,700 or 321 for married, now you got to ask, are they in a special service? Or is there not in a special service, then other limitations apply. I'm not going to go over those limitations. I'm not going to test you on those limitations. I do want you to understand that there are limitations, but we are going to go over it, just not today. We're going to revisit this in more detail next week. I'm not going to go over depreciation yet. Let's do the self-employment tax problem real quick. Okay, the problem that I want to go over is the problem, self-employment tax problem on Brightspace. It is, hold on. Okay, here's the problem. Give me a second. Okay, so I trust that you already reviewed this or attempted to review it on your own. Can you guys see it?
Yes.
All right, okay, good. All right, so a lot of it is pretty straightforward. Again, this should be the same problem. Business income is 130,000, right? Here are the business expenses. Let's think about these business expenses. Off the list, is there anything that sticks out in terms of what's not deductible, what's limited, or anything like that from this list? What do you guys think? What's limited? This is limited, right?
Yeah, the meals and
Yeah,
entertainment,
limited
right?
to, yeah, that's 3,000, right? So everybody okay with 3,000 for the meals? Not deductible, right? Yeah, entertainment, correct. That's not deductible. Anything else? Anything else? Lobbying, right? Again, something like this you'll get on the final, but you'll be able to identify what's not deductible. Not everything's deductible. Know how to apply the limits, and that's pretty much it, right? Everything else is deductible. Everything else, except for meals, 3,000 is not deductible. 3,000 is. Entertainment no longer deductible. Lobbying contribution is not deductible. So additionally, again, they made a SEP contribution of $11,000. We want to see if that's limited. Not all of it may be deductible. I don't know yet. We'll see. And here are the additional expenses. From this list, what do we have here? So this list, itemized, right? What do we have? Itemized, right? State income taxes, itemized, right? Federal income tax. Well, we don't really use that until later, right? Gifts to charity. Gifts to charity, assuming that it's a qualified organization, itemized, right? Gifts to needy family member, not deductible, right? Gift to needy girlfriend. Why is this more than fam? Anybody saw that? Well, I guess you would give your significant other more. This is not based on real life, by the way, but that's not deductible. I was just trying to be silly. In neither case, those type of gifts are not deductible. So the itemized deduction, 10,170. Real estate taxes, state taxes, that's limited to the 10,000, exactly 10,000 charity. If that's more than $12,000, we're doing it for 2018, by the way. If that's more than $12,000, we take the standard deduction. All right, take a screenshot of this real quick, because now I'm going to walk you through the solution. Are you guys ready? Again, I'm going to walk you through the solution, and we're going to do the whole thing. All right, so here's the solution. Again, I've updated the solution on Brightspace because it came to my attention that the answer is going to be the same either way. But the old solution that I had it under old, tax. Well, not old tax law. I'll explain to you why in a few minutes. All right, step number 1, figuring out net income, right? So gross revenues minus business expenses. Over here, note that this should just be meals, by the way. Only $3,000 is deductible, right? I only listed what's deductible. So 130 minus your deductions of 79,150. My net income is 50,850, right? So again, I remember by step number 1 is figuring out what's on my schedule C, right? So over here, I'm gonna just I think this is step 1. I know, and here I'm just all over the place, but I want you to know why I'm all over the place. Step 2, figuring out the self-employment tax. Step 2, right? Actually, let me put it over here. That way you can see. And step 2, figuring out self-employment tax, right? So self-employment tax and AGI deduction, right? And step 3 and 4, figuring out AGI, right? I'm gonna put it in one step. Step 3, right? But step 3 is figuring out adjusted gross income. Step 4 is over here, figuring out qualified business income. Step 4, and then step 5, taxable income. And wait, we're almost done. Well, step 6 right here. tax. What's the total tax? Well, total tax is part of the income tax, so this is step. I'm gonna put step 6 over here again. Step 6A, and then, but that's just the income tax. We also have to add total tax, right? What's the total tax? I had it over here, right here. So I guess over here. Quite a bit of steps, right? Again, you'll walk through all these steps, in more detail later. So again, you'll understand this. All right. So step 1, we figure out net income. Any questions on the net income? We already figured that out. 50,850. Then we go over to step number 2. We figure out the self-employment tax. Here's where I got my 50,850 is from this number. I multiply that by the 92.35. That equals my self-employment tax base, 46,960. My self-employment tax is 15.3% of that. So 7,185 plus whatever my income tax is going to be, that's going to be my total tax liability. But half of that is my AGI deduction. So half of that goes here. You guys see how we're 3592? I'm doing that as an AGI deduction. So 3592 goes there. And then we also have a SEP contribution deduction. That's 10,170. And then I said something about that's limited to 20% of net income. Even though they made $11,000, it's limited to $10,000, 170, 10% of net income. So again, we have net income, which is also the same thing as gross income. By the way, if they had other sources of income, such as dividends and so forth, you'll add that to income. But that's not subject to self-employment tax. Only the income from self-employment activity is subject to self-employment tax. So again, if you would have had other sources of income, you add that. But in this case, it's just the Schedule C. Net income, which is your 50,850, is your gross income minus 2 deductions for AGI, which equals 13,762. 50,850 minus 13,762. That equals my adjusted gross income, 37,088. From my adjusted gross income, I subtract my standard deduction or itemized deduction. Where's my itemized deduction? Itemized deductions on top here. We actually have enough to itemize. 21,680 is more than $12,000 for 2018. We're going to go with the 21,680. So now we got to figure out, again, step 3, adjusted gross income. We figure that out. And then step 4, we do what's called the qualified business income deduction. Here's where it gets tricky. It's either 20% of, and here's where I told you, it's net income minus 1/2 of self-employment tax minus your SEP contribution, which is actually 37,088. Wait, the number sounds familiar. It's the same thing as adjusted gross income in this case. So 37,088 times 20%, that equals 7,418. But that's not my qualified business income deduction. It's either the lesser of 20% of that number, again, 37,088, which is 7,418, or 20% of modified taxable income. Modified taxable income is your adjusted gross income minus your itemized deduction. This is your taxable income before qualified business income. You guys see what I'm highlighting, right? AGI minus itemized deduction. So that equals 15,408, which is the lesser number. So 15,408 times 20%, my qualified business income deduction is 3,082. And that's my deduction for qualified business income. So AGI minus itemized deduction minus 3,082 equals 12,326. And as we did before regarding the tax computation, remember we did this before? Same thing, you're going to do it here again. Look up the tax liability. Total income tax is 1,289, but self-employment tax was 7,185. What's the total tax? If income tax is 1,289, self-employment tax is 7,185. Total tax liability is 8,474. They made he made federal estimated payments of $20,000. The refund is 11,526. Now the solution that I gave you the pre-final, the final regs. Same answer. The last year's edition, the textbook used the old way before the final regs were issued. The final regs under Section 199A weren't issued until the middle of busy season, and the result is the same. What they actually define is this number. This is the only difference. If you look at both answers, 37,088, and what I have here, it's 50,850, which is just your net income. Before, under old tax law, they just said qualified business income was just net income, and they just said, well, that doesn't make sense. Let's take out 1/2 of self-employment tax, SEP contribution, and health insurance contribution. So that's what they came up with this number, 37,088. Most of the times, it's going to be 15%. 20% of your modified taxable income. That's the limitation. Again, these solutions are on Brightspace. I want you to go through this. I want you to go through the computation in more detail so you understand the gist of it. Because again, you are going to do something like this for the final. Let me repeat that. You are going to do something like this for the final. We're going to do more practice. We're going to do more problems. But again, the work has to be done from your end as well. It's this particular problem I want you to do over and over. And again, there's the solutions for this is on Brightspace. I updated the solution. Any questions on this? Again, pretty comprehensive. So think about this compared to the midterm question. I like this one better. What do you guys think? No commentary? Think about this for a second. What are the chances that you're going to do a lot of Schedule Cs? Well, it's actually, I'm going to say, it's pretty high. Because you're doing a Schedule C, shouldn't you be aware of all these deductions, especially the deduction on the qualified business income? Which, by the way, that has been missed a lot because some people, believe it or not, some tax return preparers don't even think it applies to their client because they don't want to read the tax law behind it, and it's too much work for them to even figure out to read it. It does benefit the client. Think about this deduction. This is a $3,000 deduction, people. I'm all for saving my taxpayers' clients. Why wouldn't I want to see if this deduction works? Because it does work. They're under the threshold. This is a qualifying business. It will work. So you have to walk through the computation.
I have a question.
Go ahead.
Where do you get the SEP contribution from?
I gave it to you. There.
Oh.
It's 20%.
Because it says 11,000 in the problem.
Yeah, it's 20% of net income.
Gotcha. Thank you.
Yeah, it's limit. Yeah, good question. So it's limited to 20% of net income. Actually, it's actually not limited to 20% of net income. I lied to you. Mia, was that you?
Yes, that was.
All right. So, did you know I was lying to you when I said it's 20% of net income? Did you know that? By the way,
no.
You were gonna say yeah. The 20% is an approximation. Take 20% of your net income. If it's more than that, then it's 20% of net income. If it's less than that, then you take whatever you put in. The actual computation for the SEP contribution, since you asked, and I was gonna give you this answer, it's sort of the way they came up with qualified business income deduction. Let me go back to the screen. Where is it? Where are my notes? Here it is. So it's that 20% is actually 25%. Hold on, it's not showing up. Oh, there it is. It's actually 25% of this number. Before qualified business income deduction, this principle that we have here wasn't called qualified business income, but there were certain limitations, just like limitations on SEP and KEO plans, was based on this number. So I guess, Treasury, the IRS said, well, it seems reasonable that we're going to use the same basis for the qualified business income deduction. So it's actually 25% of, well, more specifically, it's 25% of net income minus, it's actually more specific on this. It's for KEO plans at least. It's net income minus 1/2 of your self-employment tax, and it's limited to 25% of that number. Which, if you do the math, it approximates to 20% of your net income. But again, I'm actually glad that you asked that question. So if you see it in practice, it doesn't exactly equal 20%. This is the reason why it doesn't exactly equal 20%, because technically speaking, according to the code, It's actually net income minus 1/2 of your self-employment tax, and it's 25% of that number. But what if I had you doing that? Then there's going to be another computation that I'm going to expect you to do for the exam. In practice, when I'm estimating with my clients, I just take 20% of net income. The tax return does the exact amount. The tax preparation software does it anyway. For this exam, I want you to do the estimation, just 20% on net income works. Even on the CPA exam, they like using the 20%, with a shortcut because it's pretty close to it. But again, if you see it in practice, it's not going to equal. It may be like 19 point or 21 point, depending on rounding. It's not going to be exactly 20%, but that's the reason why. Just so you know, I'm actually glad that you asked me that question.
So then I have a question to that question or whatever. So in the problem, it says 11,000
Okay.
was the contribution to the SEP. Did we do something to that 11,000 to get that 10,000?
No. All right. So if
Okay.
I put money, well, it's limited to 10% of your net income. Do you understand that part?
Yes.
Okay, but we put in 11,000. That's what you're asking. What happened to the difference, right?
Yes.
You gotta take that money out. Same thing
Okay.
like if for an IRA, what was 10,170? So the excess 830 should be taken out. In theory, or the 830 is considered a non-deductible basis portion. Generally, should be taken out tax-free because you don't get a benefit from it, or leave it in the IRA. Once you take it out, it's tax-free because you don't get a benefit from it. So look at it that way. But you do got to keep track of it. So there's two options here: take out the 830 before before you file the tax return, or leave it in there, and that would be counted as your basis. Meaning, once you get it, it's going to be tax-free because you don't get a deduction from it. But same principle as an IRA. So if you contribute to a traditional IRA, let's say you contribute $5,000, but for whatever reason, only $4,000 is deductible. So the $1,000, you can take that money out tax-free because it's not deductible, or you can leave it in there and that's part of your basis. So when you do take it out, it's not taxable. So that's what happens to the difference. But again, that applies to our retirement account. Yeah, for the most part. Well, yeah, sort of. Not for 401ks though. 401ks are different.
Thank you.
Okay. Any other questions to this? Quite a bit of stuff, right? Well, you know what? I have one more thing to talk about, but I don't want to overwhelm you, but I'm going to go over the basics at least. Tax depreciation next, which is what we're going to talk about, for a few minutes, tax depreciation. Again, brief overview on tax depreciation. We'll get into more detail of this next week, including that big problem next week. But again, basic overview. We're going to revisit this next week as well. Types of depreciation. Now, there's two types of assets. There's personal T assets and real T assets. By the way, when I say personal T, I don't want you to confuse that and think that there's a personal use asset. It's a fixed asset. Think about a fixed asset. It's a non-current operating asset, right? It's used in operations. It's used in business. Not personal use assets. So personal T means it's not real T. It's a fixed asset that's not real T. Think of that as machinery, equipment, furniture, autos used in business operations, depreciable assets. Then you have your real T, either depreciable realty or non-depreciable realty that's used in business operations, warehouses, rental property, and so forth. So let's talk about the different conventions that apply. I'm not going to go over the specifics yet. I just want to go over the basic overview right now. We'll get into the computations next week. So the half-year convention, again, these are the conventions for personal T property, again, machinery and equipment used in operation. Half-year convention is the default classification. The way it works in theory, it's assumed that you're placing your asset in the middle of the year, and then you're selling your asset, or the last year is going to be in the middle of the year. So you're taking 50% of the depreciation in the first year, 50% of the depreciation in the last year. That's by default. However, if you place more than 40% of your personal T fixed assets in the last quarter, mid-quarter convention applies to all assets. in personal TS at least, not realty. So it applies to all personal T assets in that year. You got to use mid-quarter convention. Again, default half-year convention unless you put more than 40% of your personal T assets, then you're going to use mid-quarter convention for all of them. Both conventions use modified accelerated cost recovery. Think of double declining balance method. Well, it's sort of the way depreciation. It's double declining balance, which means it's more depreciation the first couple of years, and it's double declining balance in that respect, and then it switches over to straight line. So Maker's depreciation has a little bit of both straight line and double declining balance, but it's more accelerated than that. So again, it's modified accelerated cost recovery system. We'll get into more detail next week. So what about realty? Realty applies to all realty except for land. And they use the straight line method, and that's the mid-month convention. So the theory is it's going to be the middle of the month, even if they place it in service at the end of the month. So just to get you thinking, if I buy a rental property in January of 2020, how many months do I have to depreciate it for the whole year? So I have half of January, right, and 11 full months. You guys get that? Half of January, mid-month convention, and 11 full months. And what about for, let's say I bought it in December. Well, then it's just half a month. Well, let's say I bought it and placed it in service in October. Well, 2 full months, November and December, and half of October. That's mid-month convention. So it's similar rules applied to when you sell it or the last year. It's in the middle of the year. Now, in terms of the life, again, it's all straight line. You know, I just noticed something. This should not be here. There's only 2 types. So in your own notes, delete that. Because the types of realty, it's only split into 2 categories. Straight line depreciation, 27.5 years. Or for, again, residential, there's tenants living in it. Or non-residential, which is warehouses and so forth. That's 39 years. Quick question. A normal office building, how many years would that be? An office building. Are you going to do 27.5 years or 39 years? What do you guys think?
39.
39 years. A warehouse. 39 years, right? How about a 2-flat where you have tenants living in the units? 27.5 years. Pretty straightforward, right? Right? How about your home office? What do you guys think? Let me ask you again. What do you think if it's for a regular office? 39 years. What about a home office? 39 years. So the depreciation portion to the home office, it's 39 years, not 27.5. A lot of people do make mistakes on that, you know, and they use it, you know, different year, 27.5 years. Doesn't work. Now, one thing that is given regarding, you know, on personal T assets, every now and then they give what's called bonus depreciation. I'm going to revisit bonus depreciation in more detail later. But that applies the first year you place the asset in service. Again, they can deduct a specific percentage up to that percentage and then depreciate the remaining amount over makers. There's no limitation. You can use the full amount up to whatever that amount is. So this is where we're at right now. It's 100% bonus depreciation up until 2022. Don't know what's going to happen after that, but as part of the tax law, it's scheduled to go down from 80%, 40% to 20%, 2025. And it all depends on who's in office, president and Congress, to see what happens with these numbers. But so far, it's 100% depreciation. So you can write off 100% of your the personal T assets in the first year. So why do we go over depreciation anyway? Good question. We'll go over that in more detail later. Section 179, we'll go over that in more detail later. And then the auto provisions, 280E. One thing I do want to talk about 280F, I mean, these numbers have changed. This is why the auto expenses, the actual auto expenses may work for individuals instead of the standard mileage for newer vehicles because these limits were changed. It's a lot more now, which yeah, it works for a lot of people buying new cars. Yeah, we're going to revisit this portion next week. Again, right now I think it's a good place to pause regarding on what we cover for business deduction. So we cover quite a bit of stuff. Again, next week we're going to revisit this in more detail. We're going to do deductions in more detail. Self-employment tax problem. We're going to revisit that. We're going to do more problems in the textbook, and we are going to get started on itemized deduction and passive activity losses. So you know, it's going to go by fast. From this point forward, it's going to go by fast the next few weeks. Uh, so there's quite a bit of work to do. But I trust everybody here is ready for what it lies ahead of them. Correct? You guys are ready for the challenge, right? Right, class? Yes.
Will be soon.
Yes. Come on, class. It's
I actually I had a question because some of the numbers have changed. Is that going to be updated in your lecture notes you posted online, or will we just have to make corrections as we go?
What numbers change?
I thought you were saying about the limit on the deduction, like for depreciation,
What limit?
that we just did,
What are you talking
like
about?
the 10,000, 16,000, or did I misunderstand that?
I think you mean this part. Remember, I deleted this and I told you I make note of this because that's not there.
No, on the auto,
What about the auto?
you said the numbers changed. Next page.
Oh, I mean, no, no, it doesn't change. These numbers are still the same. These numbers change, meaning they went up. The book gives you in more detail prior years. These numbers are the current numbers.
Oh, okay. The way we understood it was that now they have changed. Okay.
No. These are the
the
new
right
numbers.
numbers. Okay.
No, actually, I'm actually glad that you asked that question. Oh no, these are the current numbers as starting 2018 as part of the Tax Cuts and Jobs Act, influenced by the Tax Cuts and no, actually, this is part of the Tax Cuts and Jobs Act. So these are the numbers. I want the book actually spends a couple pages on that. I want you to take a look at these numbers, compare it to the numbers before that. So they have it 2017 and early years. I don't have the book available, but take a look at it. The number was something like 3,000. What was it? 3,800 the first year. Then it went up to like 5,000 second year. It was very limited. That's part of the 2017. That's what I want you to get. That these numbers were increased, and because of the increase, it's actually benefiting more taxpayers to use actual auto expenses instead of the standard mileage rate. Because of this, assuming it's a new car, because the whole purpose behind this is so they can put a cap on what was called Section 280F is commonly referred to the luxury, limitations, luxury auto limitations, because the intent was to put a cap on people buying Lexus and trying to depreciate most of it, even if they use it for business purposes. And if you look at the limitations before it work, it did provide, limitations. You could under the old law, if you think about it, under the old law, you can actually, buy a car the most $15,000. Anything over that, well, you're only depreciating up to $15,000 because that's the way it works. Now it's actually much more because the base is because of depreciation on $10,000. If you think about it, $10,000 is 20% of what number? $50,000, right? So think about that. If 20% of $50,000 is $10,000, that's assuming it's 100% used for business. In essence, you can buy a $50,000 car and it's 100% used for business. So as long as it's substantiated, you can write off up to $10,000. Very good, right? That's what I wanted you to get out of it, and that's why it may make sense for people buying newer cars, in that respect. But also, bonus depreciation kicks in too. So yeah, so people with newer cars that are using their auto expenses, it actually works out for them. And under new tax law, again, under old tax law, it didn't because there were so many limitations. But yeah, these are the current numbers. Just compared to the old numbers for 2017 and early years, the book does give you those tables. You're going to see it was significantly less. If you do the math by it, if you work backwards, the depreciable base used to be up to $15,000. Now the depreciable base is up to $50,000, which again, you can buy a more expensive car now. That's what I wanted you to get out of that. Again, we'll talk about that in more detail next week because that's actually a good topic to talk about. Because should you advise your clients to buy a more expensive car if you have knowledge that they do substantiate their mileage? They're very good in keeping records. Maybe somebody in construction that travels a lot, or somebody that travels buys. Can you recommend somebody to buy like an SUV or a bigger car? A $50,000 truck, perhaps, or more. So long as it's used for business and you can substantiate, it works. Now, another thing I want to talk about, but regarding this limitation is specific to passenger vehicles. For service vehicles, so trucks will not be in this category. Cabs, ambulances, trucks, hearse, those are you're depreciated over the regular methods. So this only applies to again cabs, your personal passenger automobile. So a Lexus will apply, but if you get a truck will not apply because a truck it's you can make an argument that a truck is it's a service vehicle because you're loading material. A truck will work. So these are part of the planning strategies your clients will tell you, and they do come up with you. What's the new tax law changes? You do got to be aware of tax law changes each year. These numbers change each year, so it's not enough to learn the tax law. It's good to understand the core concepts. Core concepts not going to change. The numbers change. So I have to be on top of it and learn these numbers, and you guys have to be on top of it as well. If you want to do tax returns for your own clients or for yourself, you want to know what's the current tax law. And even with the CARES Act, that was a new tax law that the book doesn't even have. But you know what? I just thought about something else that I did not include in this note. Qualified improvement properties change as part of the. Actually, I don't know if I want to include that depreciation, but that's part of the CARES Act. It's allowing some depreciation. You know what? I'll talk about it, but I'm not going to update my notes on depreciation. Because that is a new provision as part of the CARES Act. So, anything else regarding depreciation, amortization, organization expense? Hey, it's listed there again. Hey, organization expense is 195. Amortization of intangibles is 197. Interesting. I also find it interesting that intangible assets are amortized over 15 years, straight line, which is 180 months. Whereas startup expenses, you deduct the first $5,000 and amortize the rest over 180 months. I'll say that again. 195 is very close to 197. By the way, though, after organization expense, it used to be a different rule. I think the reason why they changed it to 180 months to be consistent with the taxation of intangible assets, 180 months. The old rule was for startup expenses, it was over 60 months. Now it's over 180 months. And then I guess the other side of it is when this was originally passed, this was during Bush's administration. There was a lot of tax breaks given at that point. If we're making the amortization period longer, that's going to result in less amortization. So that's why they extended the period from 60 months to 180 months. Drive revenue. They wanted to generate revenue from businesses. Well, that's all that I got for depreciation and business activity. We'll get into more detail next week. But again, yeah, just make any changes on your notes that I've made. The only change that I made was the depreciation. I took off the convention here, and that was it. But no, I haven't made any additional changes on this particular section. And if I do, I'll update it and put it on Brightspace. But I don't see me making any changes. I'll talk about the qualified improvement property as part of the CARES Act briefly. I'm not going to test you on that. Any other questions? No questions. So you guys got quite a bit of stuff to go over over the weekend. Again, I want to remind you that we have, after today, we have 5 more weeks. And it's going to go by fast. Again, do not fall behind in class. We're going to cover, more business deductions, and then the last couple sessions we'll talk about, or the last 3 sessions or so, we're going to talk about property transactions, which is tested heavily on the final exam. But again, at final exam, I'll give you more of a guide. I'll the next the quiz I already sent you, and then next Wednesday, you'll have your next quiz, which I'll release soon. Any other questions? Anything you guys want to ask me? Not related to tax, related to tax, business related. Anything you guys want to share? Personal stories? Anything? Nothing. You guys wanna talk about
When will you
anything?
have the grades for the midterm available?
Did you check your email? There's an email I sent out today. It's in the email.
Is it by
my-
Monday? Not soon.
Yeah. Hopefully sooner. Again, the latest would be before class Monday. I want to say sooner. It's going to be over the weekend, but the latest, is going to be before next session. The only thing I would say about that, I trust you guys should have a general idea what what your performance is. I'm not going to surprise you. I think you guys already have a general idea how confident you are about some of the answers. I gave you some checkpoints for the big problem. That's what's weighed in more. So you should have a general idea on that. That's the big problem. The closer you are to my answer, the more points you got. And I want to see, actual work. And then again, I'll give you additional points if you added, my YouTube page, additional points for that. Again, the short answer question, I think, from what I did start grading them, and they're just not updated yet. I want to update all the scores once I grade all of them. So far, from what I've read, the answers for the short answer question, I think mostly everybody nailed it in terms of primary source of tax law, the judicial system, which are 2 important questions that I want you guys, to get out of it. I think everybody's okay with that part. The other sections, dependency tests and filing status. I think everybody got the filing status for the most part. Exemptions, well, not exemptions, dependent credits. Yeah, I'm pretty confident on that. Again, it's just a big problem. The big problem. There's just a couple items in general that again, what's gross income, what's not gross income. That type of stuff that I want to see for the big problem. But keep in mind that the final is going to be more detailed. The final problem is going to be a self-employment tax problem like the one you just saw. So you do gotta, even if you struggle on the tax return problem, you gotta redo that one to see if you get the correct answer. Because the one on the final is gonna be more detailed. And it's gonna be a self-employment tax problem, more steps. Just so you know, it's gonna be more steps. But yeah, that's gonna be in the next couple of days, over the weekend.
So are we gonna go over it on Monday or
Yeah. I'm not gonna go over it.
no at all?
Yeah, again, like I mentioned, the solutions are gonna be provided to you. Again, I feel that we spend more than enough time on those concepts. It's your responsibility for reviewing those, your answers and comparing them to my answers and see how close you got. Again, keep in mind that a lot of those concepts we've already reviewed. We only got 5 more sessions to go, and just keep in mind that I want to spend those. My goal is to spend time on new material going forward, not on material that we've already covered that I believe you should already be confident and comfortable with them and proficient in. If there are some areas where you still feel deficient, it's your responsibility to identify a weak area. I can help you if you want to schedule a meeting with me, help you identify those weak areas, give you tips, but it all starts with you. You got to go through once it's released, you got to go through your answers, compare them to my answers. You'll have access to the answers. You're going to have to review that on your own. And again, I would always encourage you also to do like a practice, test again. See if you get the correct answers again. Just, look at it that way. One thing I also want to say, and use the midterm to prepare you for the final. Use the midterm to prepare you for the final. I'm going to say this, going forward, because a lot of the questions are going to be very similar, and the format is going to be very, very similar to the final. But I will give you the answer, but I'm not going to go over, those questions. I will, review concepts from time to time, but those concepts we've already gone over them, enough. So I don't think it's going to. I don't want to spend more time on that because we still got a lot of stuff to talk about. But again, I'm always available if you want to go over your specific exam. I'm always available before class. Schedule a meeting with me, and I can go over those questions with you specifically for anybody. Not just you. Anybody who wants to go over your exam question or anything else in class, send me an email. Schedule a meeting with me before class, and then we'll go over your quizzes and exams.
Do we have to schedule a meeting for your regular office hours, or?
Yes. You
Oh,
do.
I just thought we could just drop in because you have the invite on Zoom.
Yeah, but I also put an email, and I also mentioned this, it's more than
Okay.
once. First email I put, and I've said this more than once. If you wanna, yeah, the hours are there, but it's not. I'm not just waiting there for students to be there. You got to send me an email in advance, so I can plan my day accordingly. And because if I'm not just gonna wait there and expect students to show up and nobody shows up. I'm gonna open up the hours is when students schedule a meeting. Again, per my email and I sent
Okay.
previously.
So like a day in advance is good
Yeah, a day
enough,
in
or?
advance would work. A day in advance. If the thing is, like, again, I have my own CPA practice. I don't I don't just teach. So if you do it the day of, I may try to get you in, but usually the day of I already have my whole day planned. So it's harder for me to try to squeeze it in. But at least a day before, I'll at least, well, no, I can't book any new meetings, because I'm meeting with students. So just keep in mind, at least a day before will work.
Okay, thank you.
But again, before you schedule a meeting with me, review your answers first, compare your answers to my answers. And again, we're gonna go over it in more detail, specifically on what you want me to go over. Again, it's you got the answers to I can help you identify the weak areas. I can help give you tips on how to improve how to study and so forth. So that's what the purpose of the meeting is. The purpose of the meeting is not to change the score. So once the score is released, that's the score. So if your intent is to, and that's for anybody, if the intent is to try to negotiate your score on the midterm, that's not going to happen. Your score is what your score is on the final, and that's posted on Brightspace. That's going to be your score. The purpose of the meeting is to go over the questions, not to go over your actual score. The score is what it is. It's going over the questions and going over in more detail.
Oh no, I wasn't even thinking about the midterm, because you said you would post the answers. That's sufficient. I was thinking I have some questions about the tax return preparation project. So that's what I was referring to.
Oh, okay. Well, now that you bring it up, what are the questions you have? Keep in mind, as a tax preparation assignment, I can't tell you if you got it right or wrong, but I can answer any questions. So I guess you can ask now. So I'm sure others may have similar questions,
Prepared yet for those questions?
or unless you want to wait.
Well, wait. I will send you an email.
Okay. Now, in terms of the question, in terms of I think that the project it's pretty straightforward. I changed the dates, by the way, to coincide with the 2019. So I mean, if it's related to that, think about the divorce was final in 2019. If it's related to that, that's the only thing I can say. And then everything else is just what's income, what's not. And but yeah, I'll still meet with you. You can send me an email and then give you more specific, guidance on that. Anybody have any other questions on the research or preparation assignment that you want to ask now? No? Any other questions at all?
Yeah, I guess. Could you? I can't find it in my notes. I was looking over it. What was the name of the two databases you recommended for searching the tax code?
Well, the book comes with RA Checkpoint. That's in your and that's part of the notes. Or maybe not in the notes. That's part of the email that I sent out. But at this point, I don't know if I mean, you're already towards. It would have been included as part of the textbook, and I did mention that in the email. And then the other source, well, I did say CCH, but I also said you could go to the IRS website. Well, the IRS website, they changed it. It's actually Cornell Law School. Is that the one you're talking about? Cornell Law
I think
School?
that was the one I was trying to remember. And was Cornell Law School the one that required a subscription, or the only one that didn't?
No, that's free. That's Cornell Law School is free. The subscription is the one that I use, Checkpoint. But that's you can get a subscription to with the textbook. But at this point, if the subscription is cheaper when you get it through the textbook, but if you get it through on your own now, it can be pretty pricey. But if you got it through the textbook, it's very cheap actually. You
Yeah,
know,
the textbook's a little weird for me because I have a digital subscription for a textbook.
yeah, I don't know how they have that with that particular version. I know if you got it through Cengage, it's digital plus you get the subscription.
Yeah,
But I
that's
don't know
what I
if
have.
yeah, I don't know what you have. Double check. You may already have it. Yeah, that goes for anybody else. You may already have the subscription with your textbook that you bought. See what edition that you have. If the edition it has the actual the research library, then you have it. Otherwise, just go to the Cornell Law School, which is actually free. But the only thing with the Cornell Law School, you got to go to Title 26, and then you got to go specific to the code section. So you got to go to Section 61, Section 62, whatever code section you're actually trying to look for. You got to get more specific. So either way works.
Yeah, if you got the online textbook through the school, then they don't. I had to return my online textbook and purchase it on the hard copy to get the subscription.
Oh, I didn't know that. So if you have the
Thank you.
hard copy, yeah, the hard copy will come with it. Okay. Yeah, if you have it already, use it because again, good, gets you in a good habit of researching the material, and not just for this case, just going forward. I like it. I use it a lot. Rarely would I do research the old-fashioned way, but I guess you can do it too if you don't have it available. But there's always ways to get to the answer, and the code section is there. It's available on the internet. Any other questions? No questions? Nothing? All right, so we covered quite a bit of stuff. Again, thank you guys. So with that, I need somebody to make a motion to